Well, I spoke with Omkar Joshi from Opal Capital Management for his view.
I think it does increase sentiment towards the whole tech space in general, especially towards data centers, AI-related stocks and themes in general. And that really does come from the fact that this is going to be a very relevant theme in the future from here. And the fact that this deal's happened overnight just gives that even more confidence that we are going to see more and more in this space. And that is very much a sector to be focused on going forward.
Is the exposure here in Australia, is there anything that you like that exposes you to that theme?
So I think in Australia, it really is more from the data centre side of things. And NextDC is definitely the largest and easiest and cleanest way to play that thematic. I mean, there are a few other operators in that space as well, like Pigico, like even CDC within Infratil, but NextDC is definitely the cleanest and easiest way to play that thematic from a listed perspective in Australia.
Yeah, and of course, overnight we've also heard Atlassian investing, I think, into DX for $1.5 billion. It's a second acquisition in a month, and it just goes to show that this deal activity is still there for AI and expected to continue. In terms of playing the AI theme, how do you like to play that at the moment? Because there's been a lot of talk about this AI bubble. Is it or is it not? What's your take?
Look, I think for any time there's a bubble, there's always something fundamental to it at some point. And I don't think necessarily AI is a bubble as such. There's definitely a few names that have gone maybe ahead of where they should be in terms of the fundamental value today. But there is obviously a lot more to come from this whole AI thematic. And there is a lot more in that we're only just starting out in terms of what it can do and what it could do for the future. So from that perspective, I think this will definitely be a thematic that will continue to last for some time. And there'll be new developments, there'll be new innovation, and it will be there to last. In terms of how I'm thinking about it, I do think data centers and even chip players like your NVIDIAs and even your Intels are actually a good way of playing it rather than necessarily going down the path of some of the more AI-themed software or any of those names, given that there will be a lot of disruption, a lot of change, and a lot of quick change in those places. So I think ultimately you do need data centers to power the AI and you do need the chips. So if you kind of stick to the fundamentals and the basics, they're probably the better way to play the theme so that even if things change over time, it doesn't really matter too much.
Let's talk more broadly, and it's all related to the US markets and the macro environment there. The Fed looks to be really diving into this loosening monetary policy cycle, the rate cut, of course, this week. What impact does this have on markets in the US, but also here at home in terms of investment strategy?
So I think the way the Fed's handled themselves has been quite good in that they have managed to communicate to the markets that we are going to be cutting rates, but at the same time, it's going to be data dependent. And they haven't spooked the markets, and they've done a very good job of messaging. And I think that's probably the most critical aspect is that we are in a backdrop of rates being cut. We're not going back to where we used to be in, call it 2021, 2020, but at the same time, it is an easier monetary policy environment. And that does mean that it is a good backdrop for equities in general and generally for risk assets as well. So it feels like a pretty healthy environment. Obviously, a lot of macro uncertainty at the moment, especially with the Trump presidency. But for now, it does feel like markets have generally moved on from that as well, and it's starting to look through a lot of the volatility and a lot of the news snippets, et cetera, that do come out of the White House right now.
Well, but can we talk some sectors that you're watching in particular at the moment, including lithium stocks? Obviously, it's been a bullish sector, had a bit of a pullback. How are we sitting now? Because it seems to be having a bit of a resurgence.
Yeah, that's exactly right. So at the moment, we are seeing definitely a lot of strength coming through in the lithium names. They've obviously come back a long way, given that prices are down still about 90% from where they were a few years ago. But at this point in time, it does look like China is now starting to get a bit more focused on potentially reducing supply. There is some talk of potentially some of the mines in China not getting re-permitted, which does start to reduce some of the supply in the market. Obviously, that does have implications on price, and investors are pretty underweight in the space at the moment, and the sector's obviously come back a long way. So it does feel like there is potentially some more upside in these names. Maybe not on a fundamental valuation basis, but definitely from a momentum perspective where you do have a fair bit of negative positioning, the names are starting to move, and fundamentally the news flow is starting to get better at the margin. And given expectations are quite low, it does start to look pretty interesting at this point in time.
So what are the names? What are some of the stocks you like in the space?
So I think the cleanest, simplest way to play it really is a Pilbara. They're the good operator, generating cash. They're in a good spot. You're not really dependent on, capital calls or anything like that, or they're not an explorer. So that is probably the easiest and simplest way, the large liquid name, and they are definitely a tier one player globally.
Okay, I want to switch gears to the banks because it's been an interesting space this week as well. Of course, we've seen that broader misconduct at the banks. ANZ fined $240 million. We've seen job losses sort of across the sector. What is your view on the banks and valuation of the banks at these levels?
So I think the valuations are definitely full. But having said that, from a fundamental bottom-up perspective, the earnings are actually in pretty good quality. The bottom-up fundamentals are pretty good. There's nothing really going wrong for the banks. They're now focused more on the costs, especially ANZ. There is definitely a lot of costs to be pulled out of these banks. Now, how far do they really go is anyone's guess. But if they do really turn their eye to it, there is a lot to be taken out, which does mean that earnings do tend to be, well buoyed going forward from here. And so from that perspective, fundamentally, they're okay. Margins are okay. As we enter a rate cutting cycle, that does give them opportunity to actually hold on to margin, especially as they reprice the deposits down faster than the lending books. So there is flexibility in terms of how they manage the revenues. There's opportunity in the costs. And in terms of bad debts, we really haven't seen any bad debts come through. The environment's still pretty healthy. It's relatively benign. There'll obviously be some bad debts pop up somewhere at some point, but it's not a widespread systemic issue. So from that perspective, the banks actually do look fine from a fundamental perspective, but obviously the valuations are pretty full and pretty stretched. But at the same time, fundamentally, there's really nothing going wrong with them.
Yeah, I mean, it's just interesting watching the banks in the interest rate cycle we're in, because we know in the US we're on a loosening cycle. There's potentially, 3 or 4 more rate cuts coming there. Here at home, though, it's a little bit more complicated. The rate cutting cycle perhaps may come to an end. We may only see one more rate cut. We could see more. Obviously, it's going to be data dependent. But if we see less rate cuts going forward and perhaps just one more to go, how does that impact our local banks?
I think my view is you'll probably see one more rate cut this year and maybe one more next year, and that could well be the end of it. But at the same time, even if you don't see any more rate cuts, the banks are in a pretty good position, and they do have flexibility to manage the deposit side as well as the lending side. And there's always a lot of focus on what are they doing with mortgage rates, but the reality is they manage it on both sides. And we saw that when rates were going up as well. They really didn't increase the rates of the deposits at the same level as the lending side. And so they did actually get quite a big margin uplift. And they can do similar things again this time. There's a lot of focus on the lending side. There just isn't much focus on what they do on deposits. So it does give them a fair bit of flexibility and allows them to fly under the radar as well effectively, while still passing on the full rate cut to lending customers.
I've got to ask you before we go, do you have a top pick in the bank space then?
Look, at the moment, I do think it's CBA. And I think, the valuation is very full. Don't get me wrong. But so is the whole space. But the reason CBA still looks good is that they are in a good spot. They are well managed. The last result was good as well. You really can't fault their execution. They're in a very good spot.
All right, Omkar, great to chat. Thank you so much for joining us on the program today.
Thanks, Ingrid.